Leading Wall Street firms have once again turned their attention to Japanese stocks, as the renowned Nikkei 225 index surpassed the 35,000 milestone, a feat not achieved in approximately 34 years. Closing at 35,049.86, the Nikkei exhibited another impressive performance, recording a 1.8% increase. This year, the Japanese index has seen a 5% growth, while the S&P 500 has experienced relatively stagnant performance. Over the past 52 weeks, the Nikkei has surged by 33%, surprising many investors. One particular investor wasn't surprised, however. This investor is none other than Warren Buffett himself, who started making bets on the Japanese stock market all the way back in 2020. You might be already thinking that you don't need to hear much more in order to start trading on the Nikkei. However, things aren't so simple. History has taught us that the stock market can crash very easily after a period of artificial booming, and Japan itself learned that lesson in the 1990s. Is this recent surge also an example of a bubble that's about to burst? Or should investors follow Buffett's lead anyway? Finally, what can US investors learn from the history of the Nikkei when it comes to the rampant overvaluation in the US market? In today's video, we will explore the recent history of the Nikkei and extrapolate from it everything that's crucial to understanding the future of both the Japanese and US markets. Welcome back to PST Markets. According to JP Morgan strategists, led by Ri Nishihara, the remarkable performance of the Nikkei can be attributed primarily to the weakening yen and the favorable risk-on sentiment prevailing in global stock markets following the Federal Reserve's decision to pause interest rate hikes. Masashi Akutsu, leading a team of strategists at Bank of America, highlights the growth in real wages as a significant catalyst during the initial 6 months of the year. Akutsu explains that the increase in real wages is driving a revival in consumer sentiment, creating favorable conditions for companies to raise prices. This, in turn, contributes to the improvement of profit margins and return on equity. This recent boom is bound to bring back bad memories for some people, however, which should serve as a reminder that hard times can come immediately after the market reaches record highs. Investors must always be on the lookout for sharp drops, or they'll be taken by storm. What bad memories are we talking about here? Well, for a concrete example, consider the case of the veteran broker Hiroyuki Kikuchi. Kikuchi took over the family business, which was a stock brokerage, in 1979, just in time for Japan's greatest stock boom ever. In 1989, he celebrated his brokerage's 40th anniversary at a luxury hotel and hired a composer and band for more than $100,000 to create a ballad titled Never Say Can't. A few months later, on December 29, 1989, the Nikkei stock average closed at a record high of 38,915.87. The country seemed on track to surpass the US as the world's largest economy, and most of the world's biggest companies at the time were based in Japan. Kikuchi, now 81 years old, remembers that everyone was feeling good. We were saying it would reach 50,000 or 60,000 next year. Companies were pouring money into stocks, sometimes earning more from the market than from their core business. Brokerages would offer a guaranteed return of as much as 7%, a promise they weren't supposed to make but seemed harmless at the time. Kyokudo Securities' revenue grew more than tenfold in the 1980s. As volume boomed, clerks worked late into the night handling the delivery of paper stock certificates. In Kabuto-cho, Tokyo's Wall Street, taxis lined up past midnight. What pushed the Japanese stock market to become the market of any investor's dreams? There was no one specific reason behind the boom. Rather, it was a combination of multiple factors that came together at the right time to drive the economy upward. For example, quasi-free market corporate acumen justified per multiples at 50 to 70 times earnings. Ultra-low interest rates and fiscal spending had fueled a liquidity-driven housing bubble, coupled with strong macroeconomic domestic demand. As manifestations of the positive results of such policies, Japanese property company Mitsubishi Estate took control of Rockefeller Center in New York City that October, when land prices peaked in Tokyo. Japan's Imperial Palace grounds were more valuable than all the land in Florida. Companies in other sectors were doing pretty well too. Sony bought Columbia Pictures, one of Hollywood's biggest studios, for $3.45 billion. Nintendo and Toyota, needless to say, were flourishing. What could go wrong at this point? Well, it turned out that a whole lot of things could.
No!
In 1990, despite a 6% total growth in the economy over the year before, coupled with everybody's optimism about Japan's future as an economic superpower, its progress suddenly came to a halt. In the first 2 years of the 1990s, the Nikkei nosedived a whopping 60%. The market lost a mind-boggling $2 trillion of its value. Admittedly, some of the gigantic Japanese companies of that period have continued to be successful to this day. Sony's PlayStation has obviously been a massive success, not to mention Nintendo's video game console sales. Toyota, too, remains the largest car manufacturer in the world in terms of car sales. However, many Japanese companies experienced a sharp decline, and now they are a shell of what they once were back in the golden age. Nippon Telegraph and Telephone was once the world's largest company. Its stock price remains 40% below the share's peak in 1987. Nippon Steel, which hit headlines recently with its 1980s acquisition of U.S. Steel, is valued at less than half what it was in 1989. Swept up in the frenzy, they never grew into those heady valuations. The average price-to-earnings ratio of companies listed on the Tokyo Stock Exchange's first section was roughly 70 in 1989, according to data provider CEIC. Japan, until very recently, had been unable to recover completely from the shock. During the 1990s, Japan's GDP averaged 1.3%, significantly lower as compared to other G7 countries. Household savings increased. The increase did not translate into demand, however, which caused deflation in the economy. In the following decade, Japan's GDP growth averaged only 0.5% per year as sustained slow growth carried over right up until the global financial crisis and Great Recession. These days, the period between 1991 and 2010 is so remarkable that it is called Japan's lost decades, or the lost score. Why resulted in the lost decades? Could that fate have been avoided? Well, explaining why the stock bubble suddenly burst is one thing, whereas the reason why the downtrend extended into long decades is another matter. What burst the bubble of the Japanese stock market was essentially the unrealistic speculation and valuations fueled by record low interest rates. For just one instance, property and public company valuations more than tripled to the point where a 3-square-meter area near the Imperial Palace was sold for $600,000. The Bank of Japan soon realized that the valuations were so unrealistic to the point of being unsustainable, and to curb speculation they decided to raise interest rates. Many borrowers at that point were knee-deep in a ton of debt, as they hoped to pay it off based on the high speculation for growth. However, when the spike in interest rates hit, they were unable to make payment on their debts, and the market was driven to a state of stagnation and debt crisis.
Shoot.
The country was crippled by a banking crisis that led to several government bailouts. As for why the crisis extended into years of either constant decline or slow progression, the reason isn't exactly as clear, but we can make educated guesses. It has been suggested that following the initial crash, people stopped investing because they feared the economy would keep on getting worse. This caused a liquidity issue, which means that people were stacking up cash, but it was not used as markets stagnated. Relatedly, some analysts suggest that Japan's monetary policy was too restrictive throughout the lost decades, and that the government failed to accommodate the failing market with enough funding and bailout. However, it is arguable that some of these guesses aren't right on the money, since the Japanese government engaged in repeated rounds of massive fiscal deficit spending and expansionary monetary policy without notable success. Finally, some demographic issues like Japan's aging population and low rates of population growth have also been thought to have played a major role in the decline. This in addition to the rise of the Chinese market and the emergence of competition on a global scale more generally. Regardless of the exact reason why the Nikkei was so slow for years, one thing is clear: the crash will forever remain a stark reminder that bubbles always eventually burst, and investors shouldn't jump too hastily on the train of short-term growth that isn't supported by concrete value. After all, the 1990s stock crash isn't the only one of its kind. The US 2008 recession also came right after a period of flourishing in the stock market, which ended when the overvaluation bubble burst. Looking at the current condition of the market, it should be clear to acute investors that there's a lesson to be learned from the stories of 1990 Japan and 2008 America that's very much relevant today. Think of the AI market, which has obviously been growing exponentially and is projected to go on. People are betting on giants like Nvidia, Microsoft, and Alphabet, who are leading the AI revolution by constantly working on incorporating it into all their products. However, the technology is still in its infancy, and it's not too unreasonable to think that the returns may not be up to investors' expectations, at least for the next few years. In addition, AI is very costly, as it requires lots of gigantic data centers and immense computing power, on top of the additional research and development money that goes into it. The negative effects of AI costs, combined with people's extremely high expectations for AI leaders in the market, have already shown themselves in some cases. For example, Microsoft stock fell after its latest earnings report disappointed investors, even though the report was very positive and beat expectations. The reason is probably that investors weren't satisfied with a merely good performance, as they expected more from an AI giant. Additionally, it could be that many of them felt that AI investments will continue to hold back their balance sheets for the foreseeable future.
Will I get over it? No.
The same goes for Alphabet's recent earnings report. The AI market had a total of $190 billion wiped off during the latest earnings season as a result of this. A similar line of reasoning can apply to Nvidia. Investors have been anxiously waiting for the chip giant burst at any time now. It seems that investors should be cautious considering the history of the Nikkei and the current condition of the US stock market. Even though the AI industry is very promising, nobody can perfectly predict how profitable it will be, at least for the next few years. This isn't to say, however, that the Japanese market is on its way to crash again. This time, the government and, especially, foreign investors probably know better than to bet on a short-term trend that's likely to stop at any point. Well, that's it for today's video. Let us know what you think about the Japanese and US markets. Are they on their way to a sharp decline? When do you think smart investors should bail out? And do you know if some other markets are roughly in the condition right now? We'd like to hear your thoughts in the comments below. Don't forget to like the video and subscribe for more content like this covering exciting market stories everywhere. We'll see you in the next video.